Thank you for joining us on this beautiful, warm summer's day. And thank you so much for everyone who tried to join us last Wednesday. And we had some technical problems with our Zoom account, and our great staff has got all of that squared away. So here we are today, Wednesday. I was going to be broadcasting from our beautiful new Arkansas office as we were there last week setting up our operations. So if you're anywhere between Little Rock and the NWA and are looking for association management or know someone out there in the land of Walmart headquarters, let us know. We are up and running with our staff in Arkansas. All right. Well, for those of you who don't know me, my name is Michael Johnson, and I am the CEO and founder of the HOA Living family of companies, and I'm very excited. It's been a few months since we've done a AES that I've been involved in, and so I'm glad to be back with you. Here's the schedule for the rest of the year, and hope that you can join us for these events. And all of our different several affiliates and companies that join us. This list will be getting bigger as our core solutions product is growing, and we're adding new management company partners, connections to our network. Different ways to stay in touch with us: social media. If you're a client, you get our community scoop. Our website, of course, hoaliving.com, and our YouTube channel, which doesn't have me doing any fun lip syncs or anything, but does, well, maybe the very first thing on there is that, but does have all of our previous AESs. So take a look there. You can also get there via our website by going to boards and then view past classes, and it'll take you to our YouTube library of courses. Hey, just a couple things that have been awesome in our company's life in the last few months. I was honored to be the CI Recruiter of the Year at the conference in Vegas a couple months ago. And thank you to all of our clients who participate in CI and in our legislative action committees. And proud to say that we've won Best of State in the Community Association Management category. It's our fourth year in a row of winning at least one Best of State medal. And FCS Community Management was named Best of SLC in Northern Utah, and CAM down in Southern Utah won the gold in HOA management and a silver in property management for 2024. Thank you to all the great employees that work at each of our partner companies, and we're excited to see what the next year has to bring. We have started, and I think we talked about this last time, just kicking it off. Very excited for our board member of the month, and winning board members receive a gift card and a trophy. I am excited to announce that our first winner is Sharon of Water's Edge, and heard those several nominations for Sharon say she's a natural leader, persistent in her quest to obtain information if something seems awry, a keen eye on financials and what's happening in the community, great judgment, great recommendations. On top of all that, Sharon is kind, wonderful, and a joy to work with. And this person said, I am thankful to have Sharon on our boards and appreciate her excellent service to Water's Edge. And Sharon is out in our Minnesota office. And I would just personally like to also add and say thank you to Sharon. I know the tremendous amount of work she does for Water's Edge, and I look forward to many more years, hopefully, of Sharon being involved in her community. Also, for our 25th anniversary celebration this year, Community Manager of the Month. And our first winner, we are excited to announce Kimberly Graff at CAM in Southern Utah. Several nominations for Kimberly. Knows answers to our questions before we even know what to ask, Debbie at Legacy at Southgate says. Full of ideas, Ken at Green Springs and La Jolla says. Excellent communicator, responsive to all questions. Extremely knowledgeable, helpful, efficient, hardworking, competent, hardworking, helpful, knows how to work with people and perform the job, Clark at Olive Grove says. So thank you very much to Kimberly Graff, our Community Manager of the Month. You can go in and submit your nominations. I think there's a slide there for the QR code there that's on the screen for Board Member of the Month. And if we're going too fast, those are also available through our social media. And there's Community Manager of the Month QR code. It's a simple fill-in form. So let's get going with today's presentation on association financials, I believe is our topic. Financials 101. And we're going to look at board duties today. We're going to look at accounting methods, monthly financial reports, and budgeting. Now, as members of the board, right, you hear these duty of care, duty of loyalty. What's the treasurer's role? If you're managed, professionally managed, how does that interact with the treasurer, who's the appointed and elected position? And then what is the role of professional management? Well, that duty of care, remember, is to act in a reasonable and informed manner when acting as a board member. So reasonable. Court is not ever going to say that their choice is better than a board's choice if they got informed information while putting together and making a decision. So the duty of care is act in a reasonable and informed manner, and then you're covered with the duty of care, which all corporations are required. Duty of loyalty is to act in good faith and in the best interest of your community. Good faith and the best interest. So this is where conflicts of interest. Some states in the United States don't allow any relationships of any kind to be entered into by associations, but the vast majority do allow with disclosure. And so if your uncle is the best roofer in the entire state and you get a bid from them and it's competitive, it's not always lowest bid, you just need to simply disclose that it's your uncle's company and then not participate in the vote. Treasurer's authority. So treasurers are the financial voice of the board and the liaison to management, who a lot of what we do as professional management is financial related, of course. They prepare budgets, plan budgets using the governing documents, community needs, community wants, reserve studies. They prepare, follow, and report. Follows, upholds the budget, reviews financials, and ensures reserves are being funded. And then they report. They work with the board to address financial status and changes. So management, what's management doing then? They're often the one these are the same three categories, right? But they're but a little different. These are action now drafting the budget, identifying issues and decisions for board review, collecting assessment, processing payment, understanding real versus budgeted cost, and then providing monthly reports in order to maintain transparency and, of course, to communicate the financial status of the association. Maintain all financial and accounting records, oversee banking, operating, savings, oversees assessment and delinquent procedures, prepares, presents budgets, files income tax returns. That's the 1120H form, is the standard one that is completed as part of management, and works with reserve specialists, CPAs, and insurance agents. So accounting methods, and this is a part that gets a little confusing every once in a while. There's different accounting methods. There's cash accounting, cash accounting, accrual accounting, and then a modified accrual accounting or modified cash accounting, which are basically taking parts of cash accounting, parts of accrual accounting, and marrying them together in a certain way. So you can see those three options. We're going to get into them a little bit. On the cash accounting, and this isn't just an HOA or POA or condo concept. This is an accounting concept. Income's recorded when it's received in cash accounting, and expenses are recorded when they're paid. Often people say when income or expenses are in hand, that's cash accounting. If you're of an older generation, such as myself, when you were younger, there used to be checkbooks, and you would fill out when you put money into the bank, you'd write a deposit, put in the deposit column, increase the balance in your account. That's cash accounting. And then you would write a check or withdraw from an ATM or swipe a debit card, and that reduces the balance, and you put that in the checking register under expenses, and it would reduce the total balance. That's cash accounting. A checkbook, check register, for those of you who remember those, is the purest form of cash accounting. If I know our payday is on Thursday of this week, and if I were to write in my check register that I have that money today, say it's $500 I'm getting paid, and I put that in my register today, well, I can't spend that money today because I don't have it. I won't have it until Thursday when it's deposited. So that's cash accounting. But the difference with accrual accounting in that example is our pay period ended on the 15th, the 1st through the 15th, and I know I'm getting paid on Thursday the 27th, the 27th, then I can book that as income is recorded when it's accessed. So I know I'm getting $500. I can put that in the register, but the tricky part is I can't spend that yet. I haven't received it. And expenses are recorded as they accrue. So I went on Facebook Marketplace and I bought this cool thing, product, and they're going to charge me in 4 equal installments of $42. Well, if I'm doing accrual accounting, I'm booking all $168 today, even though only 42 is taken out once a month over the next 4 months. So there's an understatement of how much money I have in the future and an overstatement of how much money I have today, possibly. So when we say income is recorded when it's assessed, when we're talking about association assessments in accrual accounting, we bill all the owners, 180 owners, on the first day of the month, but they actually have a 10-day grace period for there's a late fee, and some people pay the late fee and their assessments later in the month, and some people aren't going to pay at all. So if I have a $180 assessment or 180 units, at $100 assessment per month, accrual accounting, I'm going to book on the first that $18,000. $100 times 180 units is $18,000. Do I have $18,000? No, I do not, because everyone hasn't paid at that moment when it has been assessed, billed, charged on the first. So that is pure accrual accounting. So what's the history of association accounting? Why do we use a modified accrual or cash accounting method instead of all cash or all accrual? Well, for all those examples we just talked about, and the most common modified in use and recommended best practice is recording income when it's earned or assessed. So we're going to put that $18,000 on the book on the first, but then we're going to record expenses actually when they're paid. So I know that every month for the next 6 months this year, I'm getting a $8,000 insurance bill for the association because the policy runs January to December. But in this modified accounting method, I'm recording it each month when I make that payment, not the whole rest of the year in advance. Why? Why are we doing it this way? It gives us the truest picture of how much money there is. You have to have multiple reports, of course, because if you just used your statement of income and expenses and saw $18,000 on the first, you don't have that money to spend. It's coming in throughout the month, also being mixed with maybe someone didn't pay their February, March, and April assessments, and then they start paying in May, and in June they catch up and pay June plus those 3 previous months. So all that's already there. That gives you need to have a different kind of report to know what's not there versus what is there, cash in hand. And so that takes us to monthly financial reporting. And the ones we want to talk about today are the balance sheet, the accounts receivable aging report, that statement of revenues and expenses, the GL trial balance, and bank account reconciliation. Now, if you're one of our current clients, we're on the Vanica software platform for doing your accounting. In Vanica, this is one screenshot of dozens of pages. There are dozens of reports that can be pulled, but you don't need them every month. And so we use them on a specialized basis when maybe we're digging into something specific. These reports are the ones that you should most be interested in. The balance sheet is one moment in time. So this balance sheet snip that's here is of May 31st, 2024. This is the assets and the liabilities and the equity or total capital that is available just on May 31st. Today is June 24th. And so these numbers very well could have changed. A balance sheet is one moment in time. It could be May 31st, the last day of last month. It could be March 31st, the last day of last quarter. It could be December 31st, the last day of the last calendar year. Or we could run one today, June 24th, but it's important to know it's only for that one moment of time based on the parameters you've given to run that report. Your assets in an association are going to be cash accounts, not maybe liquid. There might be CDs and other investment funds that you can't just go and withdraw, and that's okay. But we don't list in 99% of associations, we don't list the clubhouse or the fitness equipment. Those are not necessary for standard association balance sheets. Same as depreciation. We don't depreciate them as well. The accounts receivable aging report is all outstanding charges and details of delinquent owners and the current collections actions, which you have a collections resolution. So you should be able to see, based on how delinquent someone is on the age, what step it's in should be following your community's personalized collection policy. Remember when I was talking about the modified and why we do modified, and we book $18,000 in assessment income on the first of the month. This is the other report we need, accounts receivable aging report, so that we can know when we have how much of that money we've booked at income has not come in yet. If you look at this, there's some hefty numbers on here, $239,000 uncollected in this pretend example, with most of that being assessments, of course. I'm trying to squeeze in and look, and late fees, but obviously this would be an association that is thousands of homes to have that kind of account balance in here. So on the 28th of February, on this particular example, that's how much owing. And then the report breaks it down by what money is owing, and then gives you a pie graph. And then it breaks down each individual owner so you can see how old all the debts are. Remember, some association documents have a like a 5% late fee. Well, if the monthly assessment's $1,000 a month, right? That's a $50 late fee, and that can add up quite quickly. And so you kind of need to know what the principal is versus the late fees, collection costs, fines, and you can see that in the detailed reports. The statement of revenue and expenses is that list for a window of time, a period of time. So the balance sheet is one particular moment. The revenue and expenses, statement of revenue and expenses, over a period of time or a window of time. So January 1st to January 31st, January 1st of 2023 to December 31st of 2023. This report here, example, is February 1st, 23 to February 28th of 23. It's going to show you your income and your expenses by category during this window period of time, but it's also going to show you your year to date. So year to date, since we don't have any associations that start their fiscal year on February 1st, most start on January 1st, the year-to-date numbers are going to be about double, or you'd anticipate them to be double of what they are for the month figures in the second 3 sets of columns. And then you can get a total variance for the year. The GL trial balance, it lists expenses for a particular general ledger line. So if you're in here and you are, let me see if I can be really cool here and figure out how to do something here. So there we go. So if you're wondering, well, how did we spend, and not looking at particular numbers, but how did we spend this amount of money in this category? Not transfers reserves, sorry, snow removal basic contract. So we spent $10,530 on that, and then our year to date's $21,000. Now, if I was running this for the month of May and June, and I saw these numbers, I'd be like, okay, I know it didn't snow in April, so why is it? But this is from February, so this is showing us February, and then we can see that January was just probably almost the exact same amount of money, right? Because it's double, and we can see versus the budget amounts for the month and for the year to date, and then here's our annual budget. So we have, for this particular example, $57,000 in the budget for snow removal, and through the first 2 months of the year, we're only at 22,800. Now remember, snow removal is tricky because it's going to have a bunch at the beginning of your fiscal year and a bunch at the end of your fiscal year. So if you want to know, though, if you want to go to category and go, wait, why did we spend $16,224 on professional services? Well, then we would pull up that GL trial balance for the period, and we could go down and we could see that on February 23rd, a surety bond, a surety building enclosure consultant's study was paid for $16,000. FCS did $175 worth of 1099 processing for the previous year. And the community amended their bylaws and had to pay election runner for that online voting. So this is the report that can break down the details from the previous report, statement of revenue and expenses. Then our bank account reconciliation shows all reconciled and unreconciled items. This is what we match up with the bank statement. It has to balance and has to, so there's checks that are sent at the end of the month that are out of the check register, but haven't, by the time the end of the month bank statement cuts, have not cleared. There also might be, and this is less and less, but there might have been a deposit made in the computer on the last day of the month, and it has not shown up in the bank statement that cut later that night. Now, we do a lot of electronic depositing now, and so that lag there is less and less. But if you're banking with an oddball bank and that has to be FedExed or emailed, then there could be lag on deposits. On expenses, there's always going to be lag because you might send it to your snow removal company and it just sits for a week or 2 weeks before it gets before they deposit in their bank and it clears your bank. So obviously, a lot of this is budgeting and how do we handle budgeting. And I just want to spend a few minutes talking about budgeting because it is the core. I think we make a mistake sometimes when we make it a little too concrete. Budgets need to be a little more flexible. They're a best guess, and they're not always going to be 100% accurate. Budget is a tool. It's one of many tools to help you run your association. And right there, right, it does not limit the board's flexibility to adjust for planned expenses as conditions changed. A well-established budget allows a board to more easily and responsibly plan community activities, manage the operations, provide services, establish assessments, and minimize unexpected expenditures. So the process is planning, gathering information, reviewing revenue and collections, and setting the assessments. You also, the obligations are, remember our hierarchy of authority and our laws and statutes are at the top. They trump everything in our CC&Rs and our rules and our bylaws. So if the government comes out and says that everyone in the community must have a minimum amount of insurance, of liability insurance that causes the rates to go up in your state, probably wouldn't be a federal law there, but a state law for some reason, that's something to know. And since that's higher up than your CC&Rs in the authority triangle here, then you would have to budget for that. In the governing documents, it should be clear language on the budget approval process. Some states require budgets to be approved by all homeowners in an annual or special meeting. Most states are not that way. And if you have to raise the assessments as part of your next year's budget, how that happens, and what are the requirements to notify your owners. 2 ways to approach budget preparation: historical trend and zero-based. Obviously, we have to use zero-based with all of our new developing clients. When a builder comes and says, I'm going to build a 350 condo community, what's the budget going to be? Well, we do an interview and an intake form. Is the city providing trash services or association? Is there any utilities provided by the association? And we build that up from zero. Historical trend is what we use for most clients. Obviously, we're looking at previous years, seeing if there's any changes. Have utility rates gone up? Have insurance gone up, which it has for everyone on property insurance, of course. And we look at those trends and then make our budget guesstimates based on that. Where we gather the information is from financial statements, surveys, reserve studies, any miscellaneous issues. If you know you have a lawsuit or something out there, or a one-time thing that's going to happen, reviewing revenue and collections, setting assessments and assessment increases. The reserve study is a very important part of budgeting and of your community's finances. This is a document that takes all your long-term capital assets, your expensive stuff, and then reviews it and says, okay, the association's responsible for 30 condo buildings' roofs and is responsible for 3.8 miles of asphalted roads, and there's 2 swimming pools and clubhouses with gyms. That is all put in reserve study, and we say, okay, this roof has 30-year life on it, and it's going to be $3 million to replace this roof at the end of the 30 years. Well, over 30 years, we need to collect $100,000, put it in savings so that after 30 years, we have $3 million in the bank to pay for that roof, thus avoiding special assessments. In the reserve study, it'll tell you how much you already have in reserve funds, how much you should be saving monthly. It'll go through the governing documents and make sure that you're meeting the requirements in there. Most states require a site visit every 3 to 6 years, depending on state. And it'll have a financial analysis of the needs and the funding. A little flyer that we like to put together for most of our communities is this little graphic of the years moving forward and what's going to be done in some of the years. Obviously, there's little things that are done every year, but this gives people the big picture of some of the things that need to be funded. Well, how do we account for unpredictable issues that can occur unexpectedly? Weather pattern changes and legislative effects, the severe drought that was in the West for several years, and the legislature's demanding that associations allow their homeowners to put in low water use, xeriscape landscaping. That's something, and even making common areas have to do the same thing. That can change. One, there's a higher capital cost to switch out the landscaping, but then long-term should be cheaper on maintenance and water cost. Utility increases always go through public utility commissions in each state, and then put in red there that insurance rate increases. The average property insurance rate increase in the country last year was 39%, I believe it was 39%. Utah, where we founded our company, the lowest increases in the country last year, but still well above what it had been for the previous decade. expensive places hit by hurricanes and those kind of things are seeing 100%, 200% increases in the cost of insurance. Big hits. Remember, when we were in Arkansas last week, inspected and toured a lot of the tornado damage from the big tornadoes that had happened there at the beginning of June. Millions and millions, billions of dollars of property damage. So it can be tornadoes, where tornadoes are happening in the country is growing. It can be hurricanes. California has gotten out of the drought the last couple of years, so is Utah and most of the West. But now lots of rain in the wintertime, it's greener, but that leads to a lot of undergrowth and it dries out. You have the hot Santa Ana winds in California, it dries it out, and you've seen on the news in the last week some big wildfires in California. All these things, insurance companies for 12 or 13 years, I heard, have paid more in claims than they've brought in. So they've been losing money for over a decade, and now they're going to catch up, as they always do. So reviewing revenue, what are we looking at? Obviously, our primary income comes from assessments that we charge, but what are some of our other revenue? Comes into the interest from our savings accounts. Not a lot, but more than it has been. Do you have a cell phone tower or a billboard? Do you have laundry rooms or soda machines or clubhouse rentals? Different things that are bringing in income to your community. For our assessments, there's two kinds of assessments, right? We want everyone to try to focus on a regular, normal assessment. And basically, it's as simple as taking the total amount needed. You figure out your budget and say, we need $100,000 to cover our expenses for the next year. $100,000, and we have 100 units. So if we have 100 units, it's $100,000, and everyone's an equal share. That means all 100 units will pay $1,000 for the year for their assessments. Now, that second bullet point, right? It's payable in whatever manner the governing documents specify. So it can be over 12 equal payments, 1,000 divided by 12, or it could be 4 quarterly $250 payments, or some associations bill the full amount and it's all due in January. Some associations, condominiums, co-ops, those kind of communities don't have equal share. That was an equal share example. They have the percentage of ownership. So 100,000 is needed, but we have to use a calculator in Excel to figure out what the percentage interest of each of the 100 units is by the governing documents, and then multiply that 100,000 times what percentage that one owner owns. I might have this big penthouse condo unit and I own 3% of the total association. So now I'm paying $3,000 of that 100,000 instead of, if it was an equal share, 1,000. A special assessment, which is frowned upon by mortgage lenders, by Fannie Mae, Freddie Mac, and by just the consumer, right? Is a special assessment is, okay, we didn't put $1,000 a year, or sorry, $10,000 a year into the roof savings over 30 years. And so now we don't have any money in that roof fund, and we have a multi-million-dollar roof to replace. So we're going to do a one-time special assessment and charge each of our owners $10,000 or whatever the amount might be. That's a special assessment. It's a one-time fee to cover non-routine or unbudgeted expenses. It can be in installments. So know that regular means it's ongoing. Special means it's a one-time. But just like regular assessments, it can be in installment payments. And so you might have a $800 special assessment requirement, and you're going to allow 10 payments of 80, or one payment of 800, or 4 payments of 200, whatever you set up. Typically, most associations charge interest and some administrative fees if someone takes a payment option and doesn't pay it off all at once, because it has to be like if the work has to be done, they have to get the money from they have to borrow it from one of their funds or from their operating account or from a loan. And then for the management company or the treasurer, there's extra work done to handle all these different administrative requirements. I love this quote. I've shared it before from Robert Nordland, the CEO and founder of Association Reserves. And he brings up this great point that deterioration is constant, deterioration is expensive, and deterioration is predictable. So the board should be setting aside funds on an ongoing basis to offset that deterioration, right? We're trying to prevent special assessments. And so we know it's coming. Let's make sure. Today's the anniversary of the horrible Surfside incident, or a message went out today about it from CI. And remember, that was an association who knew they had multiple millions of dollars of structural repairs that needed to be done, did not have the funds in their accounts, had an older clientele of homeowners, didn't want to do a special assessment, and was in the process of doing it when the building collapsed and dozens lost their lives. So it's that, could have been predicted. It was known they didn't have the money to fund or do anything about it. An assessment increase for your regular assessment may be necessary, and you have that fiduciary duty as a board, but avoiding increases can be a temporary fix that causes serious future issues. Sometimes boards say, hey, I don't want to be the bad guy, or we're worried that our owners are on fixed incomes, or inflation, the cost of everything's gone up. Remember, underfunded reserves equals eventual special assessments. Deferring maintenance equals eventual special assessments. And deferring payments equals creating debt. Once again, let me go back. The budget is a tool for effectively running community associations that does not limit the board's flexibility to adjust planned expenses as conditions change. Always don't spend time in your board meetings getting into nitty-gritty of every expenditure that comes through on the financial reports. Look at the financial reports before you get into meetings and ask good questions. Your manager, if you're professionally managed, has been trained to say, wait, why was professional services so high last month? And they're going to come to you, if you can't already see it on the GL detail report, and say, oh, yeah, we paid for that $16,000 consultant study that month. So spend the time in board meetings being forward thinking about the future. Is our reserve study current? How much, what percentage? A lot of boards, unfortunately, still make decision to only partially fund their reserves, meaning if they need 100% is they're putting all the money into reserves that they should be. Lots say, well, we're going to do 50% and see what happens in 12 years when that repair is needed. You're going to be underfunded. So always be watching that. Expenses continue to increase. Inflation is real. And we're doing everything on management side to find efficiencies for you, but you can't be afraid to raise assessments. what it takes is transparency and communication to the homeowners of the reality of the situation. Most, not the people that bark the loudest or go post on the community's Facebook page, but the vast majority of homeowners are reasonable people. And if you're communicating to them on a regular basis, the financial health and situation association, they're going to understand an increase. Well, looky there. There we are. We are to the time to have some Q&A. And if you have questions, go ahead and raise your hand and we will unmute your mic. Or if there's anything in the chat room, our Jessica or Rachel can let us know.
Yeah, Michael, we do have a question in the chat. It's from John Correa. Is it more common for HOAs to have an equal monthly assessment or monthly assessment based on square footage of individual property?
Yeah, that's a great question, John. So that goes back to condominiums. The only time I've never seen a single family home or a community where everything's detached, or even townhomes, where the assessment isn't anything but an equal share. Because the idea is, right, if I'm taking care of my own lot and those things and the common area, I'm one homeowner of 100 using it. Whether I use it or not, I'm 1/100th responsible. In a condominium or co-op, we do see oftentimes the not equal share. And a lot of times it is based on square footage. A couple states have state laws that require it to be based on square footage, but there is no law in most states. And sometimes you're like, well, how did the developer figure out? We had one building, a 10-story high-rise building, and every floor, other than floor 1, floor 2 through 10 were identical, right? So there was a unit A, B, C, D, E, F, G, H on every level, same square footage. A was the same square footage on the 2nd floor, 3rd floor, 4th floor, 5th floor, etc. And it was different from the square footage of the F unit, but that was the same on each floor. But as you went up, the developer and drafter of that documents made the assessment a little higher, with the rationale that, one, the mechanics of the building has to work harder to get water to the 10th floor, and the higher floors have a better view of the downtown area. And so they charge them extra based on what floor they're on. That you can't change it after the fact. And so why the developers and document drafters might do it one way or the other, I can't always explain, but definitely most traditionally, it's based on square footage of the actual unit. Great question. I see a couple raised hands popping up on my screen. Let's see if I can take care of those. Let's see. Marianne, let me turn on your microphone. Marianne, you can ask your question if you unmute yourself.
I would like to know how often you should have an outside audit done.
Great question. So audits, and we didn't talk about that, but there's 3 types of products you can buy from a CPA or accounting firm. The most expensive is an audit, and an audit is a forensic review of income and expenses. So a CPA will actually pull the April bank statement, will send it to the bank and say, is this an accurate representation of the bank statement you sent in April? They'll take a payment, say the payment for $16,000 to a consultant. They'll find the invoice and the check, and they'll contact that consultant and say, is this the invoice that you created for that service in January of 2023? And were you paid? Is this accurate? And they do that, they spot test for lots of different things. An audit will also go through the CCNRs and verify if the CCNRs say that budgets have to be approved at the annual meeting. They're going to want the minutes of the annual meeting to see that it was on the agenda, it was discussed, and it was passed. They'll look at the reserve study. Is it funded? Is it well funded? Is it not funded? So an audit can be an expensive process, and some states do have mandatory audit requirements. Most states, the documents simply say that if a majority of homeowners request an audit, that an audit must be conducted by the board. It's a cost thing. Because are you going to spend, if you have $100,000 budget, are you going to spend $6,000, $5,000 to $8,000 a year for an audit? Because that's how much it would cost. CPAs can also sell you a review, and a review might be $2,000 to $3,000. It's less forensic, less invasive, but can give you some of those verifications. Or you can also buy a compilation, which would be less than $1,000, which has no verification. They actually state that we're not verifying any of this information. So we don't encourage our owners associations to get compilations unless you're getting a loan and it's required. Yeah, reviews more often. And if there's any questions, get an audit. What's the magic number? Some states say if the annual budget's over 500,000, that they have to have an annual audit. If there's a concern, you can always propose an amendment to the documents that says we will do an audit annually. There's no question. The other thing on audits, just a little education here, is you can't audit multiple years. You can, but that's multiple audits. So if you wanted to audit 2020 through 2023, that's 4 audits, 2020, 2021, 2022, and 2023 that you're buying. You can't do a period of time. So it's kind of, if you have a multi-million-dollar budget, most communities I see that have multi-million-dollar annual budgets do an audit a minimum of every 3 years. That answer the question, Marianne?
Yes, thank you.
Thank you for joining us today. All right, I've got Ramon, and Ramon, I'm going to unmute you if you want to ask your question. You're muted. Okay, I'm going to remute Ramon and move to Brian K. has a question.
I'm sorry. I was
Oh, there
mute.
you go, Ramon.
Yeah, I'm sorry. Okay, what I was asking in a GL trial balance, like if you want to look at year to date and you print all the accounts or the balance sheet accounts or the expenses, but still they're too long. Is there any way that you can pull only the account that you want to look at?
Yes, yeah, that's a great question. So we can, on our system, we can, and I believe on board access also, you can filter it and say, look, I just want to see all the landscaping costs for the last year, not all of them. Because like if you're looking at a whole year, right, that's lots and lots of transactions. So Ramon's asking, the Vanica software does allow you to filter by one specific GL or a couple GLs so that you can look at those. So that's a great question. Thanks, Ramon. All right, Brian, let's unmute Brian. And then I see John Sivo, you'll be next. And Brian, you are muted. Great questions today. Okay, I'm going to leave Brian there with access, and then John, go ahead and unmute you.
Thank you, Michael. I appreciate it. If I can go back to that previous question on the audit,
Yeah.
when you acquire a new client, you have to take on what they've given you, hopefully with some assistance from the previous management company. But what kind of red flags would develop such that you might recommend a board go back and have an audit performed, or that the board should be looking for in that transition period?
Yeah, that's a great question. And sadly, that has happened a few times. Not definitely it's a minority of the time, but if what we're looking for are there reconciled bank statement reports? Because it's really hard to fake bank statements. And so if they've been reconciling every month, another thing we see is, and in Utah, we got this passed about 9 years ago. Other states have it too, but still some management companies do it illegally, technically illegally, where they're combining all their clients' funds into one master trust account. And it's very hard to pull that apart because you don't get bank statements to balance it. And so anytime someone's coming where their funds have been mixed with all their other clients, which is technically illegal in Utah and several other states, then we will ask for an audit to be done. Once again, if you're a $30,000 a year budget, we can go in and rebuild a little bit because the transaction history isn't too great. And we'll do that at a small cost for some associations. But yeah, that's why it's very important for board members to be reviewing the information. And it's really not a surprise to us because a concerned board will terminate management and will let us know, and then we'll give them the resources to go from there. We cannot, as management, do an audit for you in-house. We're a conflicted party, even if we're brand new doing previous work. And so we'll always refer you to an outside CPA. Great question, John. All right, everyone. Well, that looks like the questions that we have for this week. Thank you. Oh, no, just kidding. One more has come in. Let me.
And Michael, we've got 4 text questions that have come in as
Go
well.
for it.
Okay, so site visits being required for reserve studies, is that a requirement of the state or the company
Yes.
providing that?
Well, right. It might be in your CCNRs requiring reserve study visits to be every 2 years, 3 years, or whatever. But most states, it's in the state statute on the frequency, which is I've seen some states as little as every 3 years for a site visit, or every 6 years. But then the study has to be reviewed every 3 years. So great question.
Okay, and then we've got a board member who has a large amount of reserves, well, the association does, and they're wondering about how to get good money market rates on those types of funds like they can with their personal funds.
Yeah, I'm so excited that this is finally a question we can ask, because I felt for the last 15 years, anytime that there was basically banks were charging us to hold our money for us. Now with interest rates prolonged at a higher rate, there is some return. And there's so many options out there. I know people see the rates that credit unions offer. And to be honest, as a professional, as management, and I bank personally at credit union, my personal funds, they're horrible to do business with on a business side. So our management company, if you're managed by us, we've gone through and vetted a couple clients that we have got preferred rates that are very competitive, if not beating what's out there. And so ask your community manager, and they'll be forwarding it, and it'll be in the next issues of our newsletters, different investment options that you can see. I think we've already signed a contract. The company's called Landing Rock so you can search them on the web, and they have great features. And we've customized some products through them. Great question.
Awesome. Okay, if an association needs to raise their monthly assessments and their CCNRs state that they need a vote of 2/3 to go over a certain percentage, is there any law that can supersede that allows the association to get up to the amount they need to be?
Yeah, we've surely been talking about those kind of laws lately, because sometimes you can go and have a great town hall meeting and be very transparent and communicate with your homeowners, and they still say, no. Nope, can't raise it, and you can only do 5% without our vote, so you're stuck there. There is no law currently in our markets, but what you have to do in the worst case scenario is the board would get with their legal counsel and would go before a judge, and a judge would say, okay, I've seen you've been reasonable, you've got multiple bids, you're not wasting the money, and that just because of insurance going up, you need to raise your rates 12%, your assessment 12%, and your documents only allow 5%. You went to the owners, they said no. Now, as uncomfortable as it is, as a judge, I am going to order the association members to pay the higher rate without a vote of the owners. You got to try it first before you can do that. And unfortunately, it's a legal thing, and so it's going to cost you $3,000-ish to get that. But if you're talking raising hundreds of thousands of dollars, it's just the cost of going. I would also ask that judge at that same time to strike the language out of the CCNRs and replace it with something more reasonable that allows the board to accomplish their fiduciary duties.
Okay, awesome. We have one last one. So we've got an association who previously had equal assessments for their units. And a previous board put out an amendment that changed this based on square footage. However, when they did that, they did not do the unanimous vote, which the CCNRs called for. Now they want to go back to equal assessments. Can they do that if they didn't follow?
Yeah, so that's definitely get with the attorney legal question on that and the ramifications. But if the documents are clear on the way it's supposed to be done, a board couldn't supersede a vote of the owners, a requirement of the owners. So definitely get with legal counsel on that, and follow their guidance on how to proceed forward. All right, everyone. Well, there's the QR code. If you'd like to give a review based on today's presentation or any of the work we do with you, we would be greatly appreciated. One QR code now, and it takes you to all the different companies, so you can give the love to the appropriate place. And a reminder that on July the 17th, noon Mountain, 1 Central, 2 Eastern. I don't even know where I am on July 17th, but I'll be here with you, and we will talk about understanding board member roles and responsibilities. Have a very safe and happy 4th of July, and whatever you're doing this summer, we are always concerned that you are doing your best and living your best life. Thanks for joining us today.